so the first thing we gotta do is finish up the chapter 16, 17 general fund handout. This is the one with all the wacky accounts. Almost done with it, aren't we? So we don't need that there. I think we're all going to do another handout that's exactly the same except for a different type of accounting. And I think we'll do those. Maybe we'll do those that are the other ones that we missed. Okay, and we just wrapped up the purchases. And this is probably one of the most confusing things about accounting is that the governmental accounting is the use of encumbrances. And basically, encumbrances are, I think I told you guys this last time, but I'll tell it again. Encumbrances are putting your hand on the money so other people don't spend it. So whenever you have a purchase order, you generally make an encumbrance, and it's telling everybody, you know, because we have a legal budget and you can't spend things, you know, the same money twice. Once you make a purchase order, you put your hand on the money. Now, in regular accounting, you don't. In regular accounting, if you send out a purchase order, until that purchase order is filled, there's no transaction has happened. I mean, until they send you whatever it is, you don't owe them any money, and you know nothing has happened. But in governmental accounting, once that purchase order is signed, you put your hand on the money to tell people don't spend it again. When the item comes in, then you take your hand off the money. And it becomes an expenditure. No matter what it is, it becomes an expenditure. Now, you don't encumber everything. For example, payrolls usually aren't encumbered. There's no purchase order for a payroll. Everybody expects that the payrolls are going to be paid, and you know they know what the budgets are for those. So things like payroll, those are the types of things that are generally not encumbered. A lot of the usual expenses are not encumbered, but certainly those things that are special, that are outside the norm, those things are, I should say outside the norm, but those things that are specific for a certain year, those things are all encumbered. And because you have to tell people, don't spend this money, it's already spent. So that's what they're doing here. And you know, everything is an expenditure, no matter what it is. Okay. Another wacky thing is liabilities to other funds. This could also be receivables to other funds. I think I'm gonna get this over on and this is also kind of strange a little bit, and that is well, let's say that we have, let's do this. Let's say we have a state fund and we have a city fund. Okay. So if the city Okay. So let's say that the city owes money to the state. You know, maybe they collect state sales taxes and they got to send the money to the state. You think that that would be called an accounts payable. It's actually called a due to. If it's between funds, it's a due to. So if a city owes a state, it's due. Now the state will have that on the books as a due from. So we do due tos and due froms if they are between funds. Now, if it's somebody that is not a fund, we'll make them round so we know the difference. So let's say that the city owes landscapers. Then it's just a plain old accounts receivable. Sorry, I gotta do something here. Like we've used a million times. I should say accounts payable. Sorry about that. Accounts payable could also be a vouchers payable, but it's gonna be some kind of a payable. You know, when money's owed to someone who is not a fund. So if it's between funds, it's due to. If it's not between funds, if you need someone that's not a fund, it's a regular, uh-oh. My internet connection is unstable, it says. Hopefully you guys can still hear me. If it's due to someone outside the city fund, then it's going to be a payable. So that's kind of, you know, the so due to, if it's somebody that's not a fund, like landscapers, someone does landscaping, they owe the city, has to pay them their bill, it's going to be a payable. Whereas if they owe money to another fund, in this case the state, it's a due to. So that is another kind of wacky thing we do here. Okay. So city paid a total of 70,000 for the April payroll. The city collects state withholding taxes and federal withholding taxes for their employees. And during the month of April, the withheld taxes will not be paid to the state until June 15th, but the rest of the payroll is paid in cash. Okay, now here comes the weird part that we've talked about before. Whenever you spend money in governmental accounting, oops, that's not me. My hair is different. Whenever you spend money in governmental accounting, what do we call it? Starts with an E. X.
Expenditure.
Yeah, expenditure. So this is just going to be an expenditure. Let me fold this. But you might put what it is on there, just so. Okay, now for the wacky part. State taxes withheld are 3,000. Federal taxes withheld were 16,000. And the rest was paid in cash, I think. So this is kind of like on your payroll check. You know, you get the check and it has the total amount you earned, and then it takes out for state and federal taxes, and you get whatever's left over. Well, that's what they're doing with this. They're taking out the taxes. This is for all the payroll checks, and then whatever's left over goes out to the employees. Okay, so all money to the state. So we'll say due to. We owe them 3,000. And the rest we paid in cash. So, whatever's left over. $1,000. So these are the wacky ones, and it's because they're due to other funds. And so these are similar to, obviously, accounts payable. In normal accounting, we call those payables. Payable, whatever. For whatever reason, when it's between funds, it's going to be a due to. And people on the other end will have it as a due from. So, if the state is picking this up already, they would say, okay, we have a due from whatever town this is. Due from city, 3,000. The federal government have due from city, 16,000. So due tos and due froms. I'm not 100% sure why that is, to be honest with you, but that's just the way it is. Okay. It's paid on June 15th. So this is June 15th. So we have to pay these off. So what would the journal entry be? We got to pay off the due tos. So these two got to get paid off. So what would the journal entry be? Let's take the easy part. What are we going to pay them with?
Would it be a credit to cash and a debit to the due tos?
Yep, that's exactly it. And I would probably encourage you to do these separately. It just it's just gonna be exactly the same. So I would say do it in the separate entries, and I think I'll tell you what in a second. Oops. And do the federal. Yeah. $16,000. Having typing problems here. Yeah, so you're gonna pay off them just like you pay off accounts payable. You know, and if you add all these up, these will actually equal this, obviously, the expenditure. My reason for keeping these separate, first of all, and a lot of times, in this case, you probably wouldn't have the choice because just speaking most accounting systems, when you cut a check, you know, it's going to have to go up against something. And saying you're gonna send one of the checks to the state, one of the checks to the federal government. So a lot of times the accounting systems are set up that you have to separate them. But I would advise you not to combine them, even if you are able to, because it just saves on questions later on. Invariably, somebody asks you, you know, well, where's this? Where is this in the cash? And if you combine them, not that. If you can, you know, if you combine these and say, okay, just cash 19,000 for one entry, which you can do. I mean, there's nothing theoretically wrong with it, but it's just a good practice to keep them separate because then you can. It's easier to trace them. Whereas if you add the two cash, you say, okay, these two cash accounts are the same. I can add them together. Yeah, you can, but that's going to go in as 19,000, and someone will, you know, invariably will start looking at the cash and at the 19,000 and say, what's this for? There's nothing for 19,000. You know, so it's usually easier just to put them in separately. Okay. Do one more of these. This maybe should have been a was. Okay, the Park District collected $50,000 in March sales that are subject to state sales tax. On top of the March sales, another $5,000 in cash for state sales taxes were collected. The state sales taxes will not be paid until April 20th. Making necessary journal entries for the March 31st and April 20th. Okay, so they had sales of $50,000. They collected another $5,000 in cash on top of it. So okay, so this is just cash. It's an asset going up. I'm gonna put these in separately too. So this would be 50,000. You could put them in together, and we'll have revenues about 50,000. We'll have cash that was collected for the state. That will not be a revenue. That will be a what? What account are we going to use for the? Oops, the 5,000. I can put it in. Hold on. What account are we going to use? I give you a hint. We just used one for this 5. Yep. And so we will hold on to that money until we have to pay it to the state. Now, if you collected those all, you could put the cash all together in there. If you, again, it's sometimes easier just to do it separately. But if you know, sometimes you're just collecting all the cash at once. I should probably tell you something else about this, though. Let me see. Yeah. There are also some funds that are included in for the state, or excuse me, including the government, that are not necessarily government funds, and that they are actually for profit. and those are called enterprise funds. Because you're maybe looking at this saying, well, how come the state is taxing transactions at the local government level? They do if it's an enterprise fund usually. So an enterprise fund is something like, for instance, I live in Brookfield, we have a Brookfield Zoo. And the Brookfield Zoo is an enterprise fund. It's like a business. And if you buy something at the Brookfield Zoo, they charge you taxes on it. You buy a stuffed animal, or whatever, tiger or something like that. You pay sales tax on it. So even though it is part of the government, it's run like a business. So it's like an enterprise fund. And a lot of times you'll find things like they might have snack shops at the park, or baseball diamonds or whatever, and they run those, and those are run like businesses. If they're run like businesses, they're run as if they're for profit, and a lot of times they are. They'll actually pay taxes on that. For instance, O'Hare Airport, owned by the city of Chicago, and they collect taxes on it. When you buy something there, they'll charge you taxes on it because it is they tax it the same as if it was a regular business. It's run for profit because that's exactly what it is. So there are some funds that, even though they're governmental, that they are run as if they're businesses. There are other ones too. Things like sometimes they'll have like a city garage. You'll have the fire department, the police department, public works. All these people have trucks and cars and stuff that need to get work on. And a lot of times for those different departments to hire their own people to work on them, or to take them out to private is, expensive or whatever. So they'll have like a central garage that, they bring the fire trucks in to get the oil changed and all that kind of stuff at certain intervals, and they maintain them. Those are oftentimes run as if they're a regular business. So, they have kind of a captive customer base because it's the fire department, the police, police department, the public works and all that kind of stuff. But those are also sometimes run as if they are for profit. They'll have revenues, they'll have expenses, they'll have equipment, they'll depreciate it just like a regular for-profit business. The only thing you don't have is shareholders. Okay, well, long story short, now we come here and we have to pay, and similar to what we did up here. So this $5,000, we actually don't own that. It belongs to the state. So we're gonna take this off the books. I should put this, I should do some of this. Let me do some of this. This is a liability. And it's going up. Now, when we pay it off, it's going to be a liability going down. Our cash is an asset going down. So we have less liabilities, but we also have less cash, which is just the way it goes. Oops, didn't even do that. To bold those. Okay. Yeah, so this due to state. So we put the liability on the books up here. We got this cash, it's where we can't spend it, it's not ours. And then down here, at some point, we send it to the state, and then we take the liability off the books. Okay, we gave them their money, we don't owe them anymore. It's the same thing as an accounts payable. Same thing. Any question on that? Okay, and again, you will have payables, either accounts payable or vouchers payable, which is what we commonly use. But for governmental, actually in regular business too. But you usually have some kind of a payable, and that's when you're dealing with someone outside of the fund. So again, so, landscapers or whatever. If you buy supplies from someone outside the fund, those will all be things that are payables. If you're doing it between funds, due to or due from, depending on whether you're getting money or giving money. Okay. Tax anticipation notes. the minute you levy the taxes, there's usually a delay of whatever, 3 months or 6 months or whatever the payment plan is for people to pay those property taxes. So you levy the property taxes. Well, now, you have a government to run and you need that money now. So a lot of times what they'll do is they'll get a tax anticipation note. And these are usually really low interest rate borrowings because it's literally backed by the power to tax people. So, they're fairly low interest rate, and they're very common to have that. They'll levy the taxes, and then they'll use those tax levies as collateral to get these tax anticipation loans. And again, they're usually for a short period of time, and the interest rate is usually fairly low. It's a very common transaction. Okay, so the note carries a 3% interest rate. Okay. Oh, excuse me. Pay the journal entries for the tax and anticipation note. Okay, now let's go ahead and pick up the cash. That's the easy part. So, the tax anticipation note. Now, where did we probably borrow this money from? I should put it in there. I did. Well, just in general, where do you usually borrow money from? My mom. Why?
Are you referring it internally or from bonds, or what are you? I'm sorry.
Well, but just in general, if you want to get a loan, you probably go to starts with a B. A. And
Bank.
Yeah, usually you go to a bank or something like that. They're the ones that float you the loan. And again, very a very low risk loan. So a lot of, it's very common to have these happen because these are for property taxes, and usually they are backed by not that. Okay, so it's someone outside the government. So are we going to have a due to or a payable?
Payable.
Yep. Yeah, probably something like a loan payable, or maybe even just say tax anticipation. Oh no, I guess it's note payable. You can also put tax anticipation in there if you wanted. You don't have to put that in. But anyway, this would be a liability. Yeah, it's going up. So our assets go up, but so do our liabilities. And these are usually short term, usually paid within a few months. Interestingly, if they were for more than a year, no, the tax anticipation note won't be for more than a year. But if it was some other kind of a loan for more than a year, it would be a transfers in, because we don't actually put in. It's kind of strange, but we don't. If it's for more than a year, they almost pick it up as a revenue. I know, which is a bad way to think about it. And that's why our governments are bankrupt. But if it's for more than a year, we only keep those things on our books, our assets and liabilities that are going to be used or paid within the next year, because that's what our budget's for. So if it's for more than a year, it falls into something else. Now, this one, because it's gonna be paid within the year, it'll just be a note payable. Okay, for the repayment of the note, tax anticipation on November 1st, so we have to, well, how many months is that? So July through, so July, August. I gotta write it up. Yeah, on July 1st, so July, August, September, October, what was that, 4 months? Because we didn't, we didn't, we're not gonna use it in all of November because it's okay, so let's just say 4 months, so July, August, September, October, so 4 months worth of interest on it. Okay, so 500,000 times 0.03 times 4 equals, this is gonna be our interest payment, whatever that is. Times 4 divided by 12. 5,000. Oh yeah, because that's 1/3, and that would just be, okay. So we'll have to pay 5,000 in interest. Okay, so the total cash we have to pay out is how much? Well, we have to pay on the 500,000 plus. What was it, 5,000, 505, 505,000. Okay, now, so we write the check for 505,000. What else do we need to do? We have a lopsided entry. What else do we need?
To decrease the payables?
Yeah, we no longer know, oh, this note payable. So now we're gonna decrease our notes payable because we just paid it. We paid 500,000 on the note payable, which we put on the books at, so we're gonna take it off at. And we're still not balanced.
You have to expense the interest too, right?
Yeah, now, again, you're absolutely right, this is for interest, but instead of expense, what account are we gonna use? It's a similar, it sounds similar. Whenever we spend money, what do we call it?
Expenditure?
It's gonna be an expenditure. Yeah, you might put something in there, you know, what it's for. But yeah, it's just a plain old expenditure. Is that it for this? Hey.
I'm sorry, can you go back to number 11? I missed one. Oh, right there. Thank you.
Okay, now what we're going to do is do basically the same entries, but we're going to do them for government wide. And government wide is more like our regular accounting. It's, you know, we have expenses. We have long-term assets on the books. We have long-term payables on the books. They're very similar to what we have. The only thing it doesn't have any shareholders. It has a fund balance. Excuse me. Because no one, you can't own stock in the government, but everything else is pretty similar. And it's the government-wide financial statements are somewhat new. When I accepted for the CPA exam in 1991, they didn't have it. These came out in 1993. And the reason being is, I'll show you what the reason being is. And this is in those, if you look at the financial statements, fund accounting. Pull up my screen here. So if you look at the, it's called the handout's called Financial Statements Fund Accounting. And the first one here is our regular GAAP financial statements that, we've all known and loved for years. Income statement and our balance sheet. Oops. Could make this a little bit easier to see. I don't know why I made it so small. But anyway, this is exactly what you're used to seeing, right? I mean, this is we have the revenues and expenses equals your net income, and the balance sheet does have your assets, all of them, long-term, short-term, whatever. Your liabilities, short-term, long-term, doesn't matter, and then your stock. And this is what we've been seeing for years. Fund financial statements are a little bit different. The income statement equivalent is called the statement of revenues, expenditures, and changes in fund balances. Isn't that fun? The ACCT414, they're the ones that have the FASB, that make the Financial Accounting Standards Board. They also have GASB, which is the Governmental Accounting Standards Board. They're very clear that even though it's basically an income statement, that because it's different, we don't have expenses, we have expenditures, that you do not call it an income statement. They're very keen on not having the label of income statement mean different things. So basically, if the accounts are different than you'd find on an income statement, they say don't call it an income statement. So if you don't have, if you have expenditures instead of expenses, they say you can't call it an income statement because income statements have expenses. So that's why you get the kind of wacky titles that you see here. Statement of revenues, expenditures. Notice this is different than, not expenses. And changes in fund balances. Now, notice something. If you buy a truck during the year, normally you say, okay, that's an asset, right? That's going to be down here in equipment. So if I buy a truck, it's going to be in, if I buy a truck, it's going to be in equipment, right? So if we have a truck. For government wide, if you buy a truck, it's going to be here. The whole thing will be an expenditure in that year. There are no trucks down here in the balance sheet. The balance sheet only has, I messed up my spacing here. So, oh, I know why. Okay, so yeah, there's not gonna be any truck down here under the assets. It's gonna be expended up here. So that's a way different way of thinking of things, and that, you know, if you buy a long-term asset, it is not gonna be on your balance sheet. Well, you know, what this can be an expenditure. If you buy a library, it's an expenditure, it's money going out. Buy a truck, it's money going out. You buy postage stamps, it's an expenditure. So it's all about, you know, basically the cash that's going out is going to be, or the outflows, or whatever you want to call it. Those are going to be expenditures. It's not that we're not accounting for it, we are. It's just that it's not going to be on the balance sheet. You know, when you buy it, it's an expenditure. You don't depreciate it over 10 years. Whatever you buy it in, it's an expenditure in that year. And the next 10 years, it's not going to be there because it's already gone. It's already expended. So, you know, coming down here to this, now these are, you know, you might be wondering, well, how come these are, why is this called a balance sheet? No, you know, it didn't. It's just called a regular balance sheet. Because the accounts are the normal accounts you'd see on a balance sheet. They're you know, assets and liabilities. And these are liabilities too. They're just named something different, but they're just liabilities. Now coming down here, this is, instead of stock, you know, up here we have common stock. Okay, you have some owners. Down here we don't have owners. We just have the fund balance. And there's different types of balances, which we're not going to talk about right now. But so you'll notice that this is just current assets and current liabilities. There's no long-term liabilities. There's no long-term assets. It's just a checkbook, basically. Any question on that? Okay, you know, I think it's a little early, but I think we'll go ahead and take a break now, and then we will start up on the next thing, which will be something else. It'll be the government-wide financial statements. It'll be this one. Show you my screen. So let's say be back at 6:40, 6:49. Let's just say 7. Okay. And we'll go through these. I mean, we'll do the government-wide accounting for it, which is a little bit it's a little bit more normal than what we just been through. So I should probably save this. Okay. Oops. Okay, government wide. So in accounting for governmental accounting, you keep two sets of books. And there's nothing illegal about it, but you have one set of books, it's kind of like a checkbook we just did. Everything's an expenditure. No long-term assets on the books, no long-term liabilities on the books. It's just a checkbook. And the other type is kind of like a regular accounting. It's fairly new, and it's not without controversy and a little bit of problems. You know, for instance, you have put all the assets on the books. So, you know, how much is an off ramp on onto I-55? What's that worth? You know, I mean, you know, that's the things governments pay money for, but what is it worth? You know, it, and especially coming, you know, that they had these things on the books. How much is a bridge worth? How much, you know, see, you run into these kind of, our road, how much is the road worth? You know, you run into these kind of difficult problems when you start talking about things like being put on the books for assets. You know, and how do you depreciate them? You know, are they gonna, is this road gonna be just maintained forever? Could be. It could be that you're, you know, going planning a different road or whatever. You have all these different problems with just the type of assets that you're dealing with. Buildings, that's fine. You know, we can do buildings, we can do cars, you know, all that kind of stuff. A lot of the infrastructure stuff, sewer systems, all that kind of stuff are a little bit more difficult to put a value on, but basically they have to do it for governmental wide accounting. So anyway, we're going to get started here. Okay, so this is the government wide. Okay, now the good thing about government wide is it's like a regular accounting for budgets. We don't have any budget accounts in government wide accounting.
Yeah, I think we've already done this one.
We did?
I might be wrong, but I have when I
Well, okay,
opened
okay,
my,
now we did it. We did it here, right? So this is for the general fund. So for the general fund, oh, hold on a second. So for the general fund, we put this budget on the books, right? Now this is a different handout. This is it should be government wide. Chapter 16, 17 government wide. It's just say government wide at the top. And we're going to be doing the same, the same entries and the transactions, but only at the government wide level. So again, and you know, this is weird. So the general fund handout and the government wide, they're exactly the same set of transactions, but I just want to go through and do a kind of compare and contrast as far as what do we do with them. You know, you have to keep two sets of books. That's the way it's done. So, you know, we just went through the fund accounting one. That's the checkbook one. Now we're going to go through the government wide one, which is a different, you know, and I never know how to teach this, to be honest with you, because if I put them on the same page, a lot of times that gets confusing. If I keep them, you know, I generally try to do it. I found out that doing them completely separately is maybe a little bit easier, but I'm not sure, to be honest with you. It is as difficult because you know, you're doing two sets of transactions and they have different rules, you know, for the general fund and for government wide. So they're two different, they're two different the types of accounting, but every you know, I should say every transaction, most transactions, you'll do a journal entry for it in the fund accounting, you'll do a journal entry for it in government wide. And they're not the same entries a lot of times. Sometimes they are, but a lot of times they're not. So anyway, so in government wide accounting, there's no entry. Oops. So there is no entry for a budget government-wide. For the general fund, there is an entry. Let me do this. So general fund, we put it on the books. We have the fund balance, and we it was kind of, it's kind of like a closing entry done at the first day of the year, the first fiscal day of the year. For government-wide accounting. No entry. So general fund, we put on the books. Government-wide, no entry. So that none of these budget accounts are actually on the books. For a government-wide. As you may, the one down here, no, it doesn't really change, same thing. So, you know, we have these. These budgets put on the books for the general fund, but in government-wide, we don't put them on the books. Just like we don't put them on the books for regular accounting. You know, when you guys are in your accounting class, the regular non-wacky accounting classes, you know, when you guys do your journal entries, you don't put a budget on the books. It's a closing entry done on the first day of the year. You didn't do that. So government-wide is kind of like a regular accounting. We don't put budgets on the books. The budgets didn't happen. We only put transactions on the books, right? A budget isn't a transaction. So, you know, we don't put it on the books. Okay. Property taxes. Did I change this one? Property taxes are basically done the same. I did not change that one. They're the same as the other. You can actually just copy them if you want. So this part is going to be exactly the same as before. And that's part that is brought over that is same in that there is one, you know, there is one big difference between government-wide accounting and regular accounting, like we're used to, is that revenues are still not earned. It's still a government agency, and the revenues are not earned. It's when they are they're legally assessed, you can count them as revenues. Yeah, you know, and the amount has to be known, you know, basically what the assessment is. So you know, I think again, that's way different, right? We were used to saying, okay, until you earn it, you can't count it as revenue. Well, there is no earning it in governmental accounting. So whenever you levy the taxes, that's when you count it as revenue. You may not get the cash for a while and you get one of those tax anticipation notes, but when you levy the taxes, that's when you count it. And that part of it hasn't changed. So you'll notice that the revenue part is identical. And hopefully I left it the same here too. 5%, 3%. Okay. So these are exactly the same as we did before. We don't have to do them again. Oh, that. Ah. This is. Here we go. Sorry about that. That's gonna be exactly the same as we did on the other handout. That'll be exactly the same too. Number 5, exactly the same. You don't have to do these again. I mean, you already did them once, but I was kind of plugging them in here just to, and especially because if you did it by hand or whatever, you don't have to do it. I won't count anything off, turn it in the handout without those filled in. It's exactly the same. We didn't do this one though. I mean, I think we may as well, let's go ahead and do this one. Kind of a cleanup of what we did last time. Okay. So going back to these, here's our taxes receivable current. We collected 365 of those. So here's the question. How much of those are still uncollected? So we levied 400,000. We collected 365,000 of that. So oops. So how much the taxes levied are still uncollected? Oh, come on. You guys are toying with me. Anyone?
35,000?
Yep. Yeah, so what we're gonna do is reclassify. So there's still, you looked at this account, there'd be 400 on the debit side, 365, so it'll be 35,000 will still be in that account. So what we're going to do is take off, oops. Taxes receivable, I can just copy it down, I guess. So we have to take off the remaining 35,000. And change that into, oops. Tax receivable delinquent. So there's still 35,000 that were not collected in the current year. So there's 35,000. Wait, this is just 400,000. So from the current year, there'll be tax receivable, they'll be delinquent, 35,000. And we'll also take off the current estimated uncollectible. Now that's a credit, so we're gonna debit it. 10,000. Whoa. Okay. So this is what we ended up with after we do this journal entry. We'll end up with so still 35,000 that is owed to us. There's 10,000 is delinquent. So of that 35,000, we're probably only going to collect 25,000 if our estimate is correct. And so that'd be on the book. So that's changing it from tax receivable current to tax receivable delinquent. And again, they don't just forget about those. Those goes into the next year, and hopefully collect them. They're probably estimated they'll collect the other 25 within the next 65 or 60, in the next 60 days. And so that and then the 10,000 that doesn't get collected will be written off to that estimated uncollectible delinquent. And then they'll just cancel each other out. You'll notice that these are one goes against the other. You can write these off, as that. So if they collect the other 25,000 and write the other 10,000 off, probably won't come out exactly to that, but okay. I'm not going to go into this one. There's nothing different about it. It's you levy it for 35,000. You take the uncollectible portion off, and the rest of the revenue. One of the reasons why you do this journal entry for the delinquent is because a lot of times there'll be penalties that will get added on. You guys can't see what I'm doing. Sorry. Foolish of me. Okay, let's go back again. So this is the how long has it been? I've not had this on the screen for a while. I apologize. So the uncollected, you're going to have it. It's going to look like this. So these will be the ones that are left on the screen. And again, one of the reasons why we do this is that we will then also levy fines and penalties. It will be additional revenue for it. And the fines and penalties, a lot of times, the estimated uncollectible will be kind of high because, if they couldn't pay it, if the regular amount was too much and you add more onto it, a lot of times they can't pay that either. Or that makes it even harder to pay. So a lot of times the uncollectible for the fines and penalties is actually pretty high. But anyway, we'll skip that one. Now let's go to number 7. Cash revenue and receipts, that'll be exactly the same as down here. So number 7, exactly the same. So the one thing you'll notice is that from between the government, for the fund accounting and the government wide, the revenues are pretty much exactly the same. There's no difference between the revenues. So, what's the revenue for one is going to be a revenue for the other one, generally speaking, for the normal course of business. Okay. This is much different. Okay, so purchases. Now you recall over here, the wackiest kind of accounts you've ever seen in your life, encumbrances, expenditures, vouchers payable. I guess that's not too wacky, but encumbrances and expenditures are kind of new. So, or encumbrances and expenditures are kind of new. So, you know, for government, for the general fund, you know, it's pretty involved. Over here, government wide, when you place the order, the purchase order, notice that no transaction has happened yet. So for regular accounting, when you place the purchase order, you know, you don't owe them anything. They haven't given you a truck yet. So regular accounting, like the general government wide, is going to be no entry. So purchase order, on the purchase order date, no entry. And again, this, encumbrances are a budget account, and they have no budgetary accounts. In government wide. So no entry. Over here, we put our hand on the money. Hand on the money, look, you can't spend this. We have an expenditure, you know, or encumbrance, you can't spend this. Government wide, nothing has happened. There actually has been no event. When the pickup truck does come in for 53,701, over here we had to take our hand off the money for the general fund. Well, we never put our hand on the money, so we're just going to come down here and do this. Now we're not going to call it expenditure. We're going to call it probably equipment or something like that. So we're going to have equipment. Hold this. Uh, 53,701. And they use vouchers payable, so we use vouchers payable. Saving is accounts payable. So, you know, compare that to this. Over here, it's just an expenditure, like any other expenditure. But we actually put it on the books here as just equipment. And we're going to put this on equipment. We're going to depreciate it. There's no depreciating a truck over here because there is no truck. Over here, we do have a truck. Now, when we pay it off, it should be the same. All right. So you got to pay off that vouchers payable. you know, this is the same journal entry that you'd have in, you know, that's like accounting, you know, 210 or whatever. It's just regular, kind of run of the mill accounting. You bought a truck on credit, and then you paid off the payable. You probably use accounts payable, you use vouchers payable, but same thing. Vouchers payable and accounts payable are really the same. It's the same thing as accounts payable. And again, we, you know, they always have us use this in governmental accounting, and you know, they think it's a big, they don't act like it's a big thing, but it appears as if it's something new, but really it's not. A lot of businesses, I don't know if you guys where you're working, but a lot of times they'll have vouchers payable. And you match up the documents. I think I talked about this. You match up the receiving report, the purchase order, and the invoice, and then you pay it. And now you could pay the accounts payable, or you could take the accounts payable and make it into a, instead of having accounts payable, you put the vouchers payable on the books. And a voucher payable just says those three things have been verified and been canceled, so you don't pay them twice. But it's businesses use vouchers payable all the time. Okay. And same thing here. You know, this is going to be when you purchase it. When you make a purchase order, no entry. Nothing's happened. The orders received for 1,125. It doesn't say, well, it's possible you break these apart because they may have different depreciation ones, but the knucklehead that made this didn't do that. So let's put the whole thing on books, maybe it's office equipment. $1,125. I'm sorry. Payables, liability. The liabilities are going up. We owe more money now. We owe 1,125 more money. Whoa, what did I do up here? And down here, same old song and dance. We take the vouchers payable off the books. We pay for it. So again, you know, this is kind of like just regular accounting. This is what you guys have seen. You know, the voucher payable, same thing as an accounts payable, but you know, the idea is exactly the same. Put a liability on the books, you pay off a liability later. So liabilities go up. How do liabilities go down? When you pay them, that's when they go down, so. And your cash goes down too. And notice that is way less work than all this. This is going to be almost the same. This is going to be almost the same. We're still going to have the due to and due from. There's going to be one key difference here, though. And that is, this is going to be an expense. Oops. Be an expense. Let's name it right first. We get rid of all that stuff. So, comparing and contrasting, this is an expenditure for the government-wide, excuse me, for the fund accounting. Whereas here is an expense. So expenditure, expense. Payments will be exactly the same. I'm doing this wrong. Let's quicker this to right. I mean, so these will be exactly the same as before. So one will be expense, one will be an expenditure. This one will be exactly the same. 11 will be exactly the same. So both of these, so both the 11s will be exactly the same as far as the. tax anticipation note will be almost the same. This will be the last thing we do. It's almost the same, except for one thing. So for government wide, there's only one account that needs to be changed. We can come up with it, yell it out, because that's gonna be the last thing we do tonight. Yeah, it'll be the last thing we do tonight.
The interest expense?
Yep. So the expenditure is gonna be an expense. We don't have expenditures in regular accounting. So this will be an expense. So you kind of see that this is kind of like our normal accounting. I mean, with a few exceptions for the revenue, everything else is pretty much the same. You know, it's regular accounting. It's the same accounting that we did in you know, accounting 210 or whatever. So it's not too different, other than the revenues. Is it no we've been having, and it doesn't have the wacky budgetary accounts. It doesn't have encumbrances, and it doesn't have the budget. Yeah, it doesn't have it. There's no budget put on the books. So government wide, it's a second set of books, and by the way, you'll be. Let me go back. You'll be making both these entries. So, for instance, let's go all the way back to the beginning. So they hand you a budget. They say, here's the legal budget. We want you to record it. In the one set of books, you're going to record all this. In the other set of books, you're not going to record anything. Same thing for that one. You go to number 3. You're going to record this on the books for number 3. You are going to go make the same journal entry for both set of books. So this set of books, you're going to make the same tax receivable, estimated uncollectible, unavailable revenue. You're going to do the exact same thing on this set of books. You know, it's going to be like that for, you know, for all of these. You're not the ones that are the same. You know, so for the most part, you know, especially things like revenue, you're going to be putting the same journal entries on 2 sets of books. All right, so you know, usually you hear about someone keeping 2 sets of books. You go, okay, they're doing something illegal, it's like tax evasion or something. But in this case, you're required. You do one set of books that is kind of like a checking account, just to make sure that they meet the budget. The other set of books is like a normal accounting. And there is no budget on it because there isn't a budget in regular accounting. A budget isn't actually a transaction. So the one, you have a legal budget, has to go in the books. The other is, hey, you know, pretty much normal accounting relative to, you know, at least relative to the other one. Question on that? So you're gonna have 2 sets of books. No, okay. Well, let's stop there. And I will put a, so I don't forget, like I always do. I'll put it here. So I'm going to put the fund accounting and the general fund accounting, I should say, and then the government wide handouts and in the assignments. And
So in all, how many 2 of them, right? The government wide and the general fund.
one more time.
How many of them is it 2? The general wide and government and general fund and government wide, right?
Yeah, just these two
submission?
handouts. Yeah, these two handouts.
Okay,
And again, it is weird. And I was every time I teach this, it's like, I could put them on the same page, but then, I get, you get questions like, well, you just told us to do it this way. You're like, well, okay, yeah, for that set of books. Hey, look, I'm all blurry. For that set of books. What's wrong with you? My camera doesn't like me. All fuzzy. Okay, so anyway, so yeah. So I'll put that on the into the assignments. And let's see here. My fuzzy me out of the way. So these two I will put as do on Friday 15th. So these two. Okay. And we're gonna still do more work on it. Yeah, there's a lot to these. But anyway, any questions on that? Okay, I think next week we'll probably do a little bit of talking ahead of class, and then we'll start working on a couple of those problems I sent out. But we'll wait till next week to get to that. Okay, well, you guys have a good evening, and I will talk to you in a week's time. Okay. Good night.
Thank you.
Thanks, guys.
okay, bye.
Thank you.